What is happening?
What's going on? How are you?
I'm doing great. How are you?
Doing good, doing good. Kind of been these past few days, just been so busy. Like the whole weekend, Benzinga is hosting that event, right? So there's been some planning with that or whatever. You're going to be there, right?
Oh yeah, yeah.
Yeah.
Yep. Yep.
I think we
Be there,
haven't.
and then apparently the next day, this just kind of came across, but the next day, Trade Station is having something in Miami, and it sounds like the entire like a bunch of people from Benzinga are going down to that thing, and they just invited me to speak at that. So I'm gonna head like as soon as Benzinga's over, I'm getting on a plane and going to Miami, and then doing the Benzin or the Trade Station event the next day. So it's gonna be a
Cool,
fucking
cool, cool. I just actually moved down here. So
Miami.
yeah, yeah, yeah.
Oh, nice. Where were you before? New York?
Detroit. Detroit.
Mm,
I grew up
that's
there.
right. That's right. That's where the um connection to Benzinga came from, right?
Yeah, yeah. So I was really passionate about markets and I had a tough time getting into markets. Like I went to a school that's not like targeted by any of these big financial firms and so on. So
Yeah.
I was like, I'll just hack my way in, right? So I was like, oh, I know about this company, Benzinga, they're in Michigan. I'm like,
Yeah.
oh, what if I just I didn't even apply. I just reached out to Jason, who's the CEO, and I was like, hey, I know nothing, but I'm very passionate and just give me something or whatever. Like
Right.
I'll try my best. And he's like, oh, do you want to be like a writer? I was like, yeah, sure, I'll be a writer.
Yeah. Sure. I've never done that, but like, let's party. Yeah.
Yeah, yeah. But for years before that, I was just reading, like I always wanted to trade for a living, but I didn't know what that looked like. And I just was self-studying. I was reading every textbook you could read out there. I was reading dynamic hedging, all these kinds of books, but like nothing really clicked because there wasn't like any guidance or whatever. It was just kind of like throwing a bunch of information at myself. But eventually, through Benzinga, I got some opportunities to talk to people, some mentorship here and there. And long story short, instead of going out to like a financial firm, I was like, you know what? I'm going to try this myself. I saved up enough money, and that's exactly what I did. And on the
Right.
side, I worked for this company called Spot Gamma a little bit. I did some analyses through them and
Yeah.
mainly focused on kind of using options as a tool to express my opinion, whether
Yeah.
bullish, bearish, or whatever. So
Yeah. I
that's
love
what
it.
we're gonna get into today, right?
Yeah. Absolutely. Do you still stay in touch with Brent from Spot Gamma?
I haven't talked to Brent in like a year. I was there from like 2021 to 2023,
Okay.
and I ended up leaving because quite honestly, they needed more, and I honestly could not give them more because I
Oh, yeah.
was I was just so burnt out. I was doing Benzinga, I was trading full time, I was doing
Yeah. It's too much.
spot gamma, and I don't know if you like read my newsletters, but there's
Yeah.
so much like mental bandwidth that like you're so exhausted at the end of the day, and I was doing the end of the day writings,
Yeah.
and it was kind of like I
Much.
can't do this anymore.
Yeah. I totally get that. It's also, I think when I started out, especially at the beginning of my career, wanted to I wanted to like understand where everything was all the time, right?
Exactly.
Like where I had this, incredible idea that I was going to be some like soothsayer of macro trends because of, where gold is relative to silver and the soybeans and the natural gas and what is liquefied natural gas going to do to the energy market, and the ultimate reality is that like you just don't have you have limited bandwidth, right? And you
Exactly.
just don't. The people that have the ability to kind of like conceive of the world in that way are usually like somewhere on the spectrum, and you have no ability to have like a normal conversation with them because they're like in their own world. I mean,
Yeah.
like people like Stanley Druckenmiller, he like there's only one of those guys, right? Like it's impossible to there's only one of them. So but that's kind of what I learned after a little while is like you can look at all the stuff all the time and kind of know where all of it is, but you're never really going to be good at
Yeah.
doing all of it unless you're like especially gifted, which I wasn't. So
Yeah. I learned that a bit ago. I was I was doing everything. But then I found out that like if I focus on a specific market, and as long as you know kind of like, like let's say I'm focused or kind of trying to express my opinion mostly using options, it like makes it so much simpler
Yeah.
because does that kind of make sense? It's like I know what I'm going to do in this
Yeah.
situation, just given how, even if I don't know or like have an opinion on direction, it's just like this is like what feels right or what's going to fit here. Yeah.
Yep. Well, and in that way, you can look for certain circumstances that line up that align with the way that you're thinking about things,
Exactly.
and then figure out where the best place is to express that based on asset class, volatility levels, skew, kurtosis, right? Like all of those things start
Yeah.
to factor in, and it becomes a little bit more, it sounds complicated, but in some ways it's so much more simplistic to be able to say, like, I'm looking for a way to express long vol. Like, where is
Yes.
the best place to do that, right?
Yeah.
Um,
100%.
and
100%.
what's the best way to do that, right? Oftentimes, like, just being long straddles is not the best way to express a long vol position,
Not
right?
at all.
Because
Not at
it's too
all.
costly, or there's too much roll down on it, or too, I mean, like, there's so many different ways to express long vol. So
100%. All right, so I suppose we'll just get into it.
yeah, are we recording now or no?
Yeah, I'm recording, but
Okay.
I'm probably gonna
Okay,
chop it
great.
up in a little bit.
Yeah, yeah.
But I guess kind of to jump into things, how did you get into markets? You told me the story before. You were into, I think it was music, but markets were kind of like a serendipitous thing. So kind of go into that.
Yeah. I Serendipitous is a good word for that. So I studied music and philosophy in college. And so I have three pretty useless degrees. One in actually two in music performance and one in philosophy. Um and I was a saxophone player. And I still am a saxophone player. I play all the time. But I was at a gig and I met the drummer's brother. This was like 1998, who was an options trader. He was an old, like, O'Connor Swiss bank guy,
Yeah.
who was around. That's kind of a famous, like, nexus for option trading, and a lot of where a lot of the Chicago genesis of options trading got started is in that O'Connor school. Um, and we started talking after the gig. It was the drummer's brother, and we started talking about math and things of that nature. I'd always, been relatively good at math, and he said, you should come down and talk to my partners, and let's, see where this goes. And I was like, okay, like, whatever. So I showed up, had a great meeting with them. They offered me a job, like, on the spot as a clerk to
Yeah.
become a trader. You have to keep in mind this was 1998 on the floor of the CBOE. It was a very heady time. There was a lot of things going on, right? We were like in the run up into the NASDAQ bubble. And so, in some ways, it was serendipitous for a couple of different reasons, but in some ways, you're looking for like warm bodies, right? In that
Yeah.
situation. First of all, the floor is an incredibly chaotic place. So, whoever you get has to be able to function in that environment, or be excited by it, or just have some sort of proclivity for functioning in that environment. And then secondarily, you need someone who's going to be fast, quick on their feet, and understands math. And I happen to kind of like fit all those bills. I'm also relatively tall. I'm about 6'6". So that helps also when you're dealing with, keep in mind, back then, we're talking about 1998. These are all pits with 100+ guys in them. And so being tall and big and aggressive helps in that regard as well. So it just kind of, all of the stars aligned in that way. And at that point in time, you were a clerk for 6 months, and then they handed you like your gun and your badge, and you like went out and you also have to break into pits, right? Pits were a very insular environment. And if you think about the way options trade, there's a limited amount of edge or money that is coming into the pit from orders that are coming in. And so you have to think about it in terms of, if you're dealing with a limited amount of edge and you have 15 guys, or 20 guys, it gets split up 20 ways. If you have 100 guys, it gets split up 100 ways. And so they were incentivized, and eventually I was incentivized also as a member of a pit eventually, to keep people out, right? You don't want more people involved. Also, especially if you have really great products where everyone's making a lot of money, you don't want that broadcast to the world. So you have to go through the process of like breaking in, which means you stand in the back and people yell at you and get, like call you the worst things that you could possibly imagine, insult your mother and your sister and your girlfriend and all those things. And eventually through the process of just like showing up every day and getting beat down, you go through this hazing process where you get accepted into the fold, and then you all of a sudden are a member of a pit. So regardless, that took about 6 months as well. And so you have to have the ability to, like withstand that kind of hazing. And then once you get in, it's a completely different environment. Right. So that's kind of the story. That was 1999. That was a long time ago. So my career has had many different iterations of trading since then, but that's that's where it started. That was the genesis of the whole thing.
Sure. What products were you trading back then, and how long did it take you to, so it takes you a year to get into the pit, but how long before you get comfortable kind of managing that risk, making quicker decisions and so on?
That's a good question. I stood post one, station one, which was Xilinx, which was a chip maker at the time. There were a couple of like really high flying, crazy internet stocks that I can't even, I think one of them was Dolphin Technologies. I think it was DLPH or something. And Vodafone, which was an ADR, right, which is a American Depository Receipt. So that was a European company that was listed on the United States Exchange. And a couple of other, headline stocks that were in there to begin with. It takes a while to understand, the funny thing about it is, you said it took a year to get in there. It really takes about 6 months just to like show up, to get into a situation where you're allowed to start trading, right? I learned put call parity and all of those things, but I stood next to a guy who had, I had a limited idea of things like Vega and Gamma and Delta and all of those, right? All of those things. Like I said, right? You're dealing with in 1999, you're looking for warm bodies, right? Like people that can understand relatively how these things work. You don't have a very deep understanding when you first start trading of risk in general. You're just like in the pit and doing everything that all the other guys in the pit are doing. And through kind of the process of osmosis, you end up learning how risk management works. In some ways, everyone in the pit has the same position on because of the order flow. And so once you're accepted into the pit, you end up like learning the risk management ropes through kind of like getting your teeth kicked in and losing a bunch of money. I mean, like it's hard to say it that way, but in many ways that's how it works. Like I have this giant call spread on it. I'm long 500 call spreads and I'm short stock against it. And the stock rallied right up to the long strike of the call spread and it expired there, right? That is the worst case scenario for something like that, especially if you don't have it kind of like creatively hedged. But if you have it hedged on a delta neutral perspective, you get smoked on that move because you're short stock all the way up and your call spread never kicks in. And if everyone in the pit has that on, the collective groans as the stock rallies like 20 cents every day into expiration and then pins on the strike on Friday is really instructive to you if you don't really understand what's going on. You just know, my P&L is incredibly negative every single day. Why is that? And then you start to kind of put the pieces together. There are these old guys in the pit who have been trading forever. Everyone's talking about their positions, right? Like, oh my God, could Vodafone rally any slower, right? Like those kinds of things. and you start to put the pieces together, and then you learn it, the risk management part of it, you learn kind of in a piecemeal kind of way over time. The funny part about it is that, we talked at the beginning of this about how you started and how you were reading all of these books, right? Like dynamic hedging and things like that. Those are incredibly complex books. Never in a million years would I have ever even thought about picking up a book like that in 1999, right? There were so many things going on. I was just trying to keep up. Like, I didn't have time to read, Nassim Taleb. I was like, I didn't even know what that was. I do now, and I love reading that stuff now, but it's a much more informed and kind of nuanced understanding of the landscape that's built up over, it's been a long time, over like 20 years of doing this. At first, you're just busy getting your teeth kicked in, trying to figure out what is going on. And that part is part of, it's the steep part of the learning curve, just like anything else. So.
Gotcha. Yeah, that's cool. How much of a psychological effect do you think was in play back then versus today with all this? You have automation and you're removing people from physically actually trading these things, right?
Yeah, that's a good question. I think the automation part of it, there's two sides to that coin. It helps in some ways. It takes out the emotional part of making trading decisions. It also takes out the human aspect of risk management. And I think those are kind of complicated things to weigh on both sides of that. From a trading perspective, taking the emotion out of trading, as long as you feel like your model is reliable and you're always kind of checking on it and tweaking it, and it's, your baby, and you understand how your model works and you understand why your automation is making the decisions it's making, and you're on top of that, I think taking emotion out through automation can be a very good thing. I think the problem arises when people tend to substitute automation for good old-fashioned risk management. And I think the combination of those two things is the ultimate, right? Like, I want to be able to have all the good parts, which is remove all the emotion from the trading, so that I don't have FOMO, right? So that I'm not like buying call spreads as the thing is running because everyone else is buying call spreads, things like that. And I'm not selling my stock when I'm short gamma because everyone else, those kinds of things. But it also, right, if you're able to kind of really dig into how the model works and understand that just because you have a sophisticated model doesn't necessarily mean you can like let it do all your risk management. I think that's really the ultimate kind of like combination of those two things. It is interesting though, when I think about like how your question is, how has it changed the industry? That's a really interesting question as to whether or not the industry going forward is better suited or not quite as well prepared for the events that are, on the horizon. I don't know the answer to that question. I do know that trading in the pit in 2008 was incredibly educational for me. And being able to experience firsthand an environment like that is something that is a visceral experience and imprints certain things in your mind, especially as far as risk management, that I will never forget. And if you're in a situation where your computer is doing all that for you, I'm not sure how much of that visceral experience you actually get, that it gets translated to you. But I don't know. I don't want to go out there and say like, automation is removing all of those good parts from the market making community or the trading community, because I don't think it is. But I think it's a balance, right? It's a delicate balance that I think people need to navigate intentionally and like thoughtfully,
Gotcha. Now, you weren't just in the pits, you ended up moving or stepping away and then building trading businesses. I take it you went to London for a while, then you came back, but you kind of
Yep.
did the same thing in the US. So what exactly were you doing kind of after trading in the pits?
Well, trading in the pits was, I kind of had two instances of pit trading at the very beginning and then at the very end. And in between was London for me. London was a marketplace where, unless you were trading metals, pit trading didn't even exist anymore. By the time I had moved to London, I went over there for a company called DRW. The pit trading of options had migrated to what they call an upstairs model, right? A phone around marketplace that was also supplanted by and kind of like side by side with an incredibly robust electronic presence that was in some ways kind of like one of a kind at that point in time. It was pretty early on for the electronic markets, but those electronic markets had been being developed in places like Amsterdam for a long period of time. And so Eurex was uniquely positioned to do all of the like co-locating of servers in the basement and doing all of that stuff, the arms race that comes with all of the electronic trading, that, you know, everyone needs to be faster and better than the next person. And so that was like early 2000s. And I traded Bund, Bobble, and Schatz options over there, which is the German twos, fives, and tens. So German bond options. It's the long end of the interest rate curve in Europe that's like very actively traded. Bund, Bobble, Schatz is. And then the other side of the desk traded a short-term trade, which was Euribor, short sterling, and some other pieces of the shorter part of the duration curve in the interest rates in Europe. And then we had what we combined together as this, what we would call a relative value book, which was finding opportunities where we felt like things were mispriced, but they were mispriced relative to something else. And so we would have like, you know, mid-curve options in the Euribor versus you know, like bobble options that were on the 5-year, but you know, so like it's a mixture of duration, and then you're trading vol against each other, doing all, like really complicated stuff. It's really interesting, but it's also incredibly hard to kind of explain and right, it's also incredibly hard to model many times. But so my pit trading was at the beginning at the SIBO, and then I went to London and traded Boom Bobble Schatz on the phone and in the call around market and on the screen. And then when I came back to the United States, I started and ran a index options market making business again on the floor of the CBOE with 3 other partners. And we ran that for about a decade, right up until like 2016 or so.
Sure.
There are interesting parts about both of those trades. You know, the interesting part about London is that it requires you to be very dynamic and kind of malleable in how you, if you're coming from a pit environment and you're walking into a phone around market, first of all, there's there's an incredible amount of learning curve again that exists there, and you have to be able to like interact with people on the phone and then hedge things on the screen kind of at the same time. It's parts of that were incredibly difficult to pick up at first, but once you get the hang of it, it's a really dynamic and an exciting place to trade. I worked really, really hard, like, you know, 15, 16-hour days. The Eurex schedule at that point in time was extensive. I mean, the Boom Bubble Shots options were open like, I don't know, I think we opened at like 6:30 in the morning and we closed at 6 p.m. at night. It was aggressive. And then we did a bunch of entertaining of brokers and things of that nature. So I was working like 24 hours a day, basically. And I burned out pretty quickly over there because of that. But it was an absolutely incredible learning experience. And much of the success that I had after that was due in large part to all the things that I learned while I was there, you know, in that environment. So those are kind of, that's the pit trading, screen trading, pit trading kind of the bookends to that part of my career.
Sure. So you go back, you start working in index options, right? And what was the interest in getting into index options, right? You said 10 years, so this must have been around 2006, right? In the lead up to the financial crisis, right?
Yep. Yeah. We started that not as we didn't have any kind of grand vision other than the fact that we had a decent amount of collective experience in that kind of like marketplace. I had never traded index options in the pit at that point in time. All of my pit trading had been equity options at first, but the other partners in that firm were all index traders. Some of them started in the equities, but then had like very quickly moved to index options. So there was a lot of experience there that we were leveraging. The other thing that's interesting about the index pits, especially on the SIBO at the time, they were massive pits. So you had 300 people in these pits. In a pit where you have that many people, the spot in which you trade, in which you stand, the actual physical spot is incredibly valuable. And your actual proximity to a broker, and hopefully a very good broker, is like even more valuable. And so there are parts of the pit that are really, really valuable to be a part of. And then additionally, when a pit's that big, there could be two things that are exactly the same that are trading in different parts of the pit at different prices at the exact time. And so you need what is called pit coverage. You need to be able to be involved in all of the places because things trade at different prices in different places. And part of the natural physical arbitrage that exists in a pit of that size is just the fact that, you know, the call spread traded for 350 over here and it just traded for 3.25 over here. Right. That part is interesting. There's another part of it that's all about, you know, just the modeling of the vol surface, which I think is more interesting to me personally, but the physical part of it can't be underestimated, right? That part is important as well. And so a lot of the people that I partnered with at that point in time had experience and had spots. Some people had spots in the pit, which is a big deal when you're starting out, right? It gives you kind of a head start. You don't have to go break into every single one of these spots to create a viable business model. So that's kind of how it started.
Gotcha. So you kind of you do this up until 2016, and then I think that's kind of when a lot of these operations maybe kind of wound down, or you heard a lot about, or a lot in the news about these pits kind of winding down. Do
Yep.
you do you think pits have a place today? I know, you know, the CBOE still has pits. I mean, you have MIAX, they're opening a pit in Miami.
Yep.
Yeah, do you think they're still relevant?
Yeah, absolutely. I think the industry broadly has been sounding the death knell of the pit for 25 years and it's not dead yet. You know, it's one of those things that it's like you can only write a headline about how pit trading is dying so many times before you're like, maybe it's just never going to die. I mean, the point of the matter, I think, is that, and maybe what the SIBO has hit on, either intentionally or unintentionally, by, and look at their volume numbers as far as their index options, and those, especially those index options that are traded electronically and in the pit side by side. And what I think you'll see is that oftentimes you can find this sweet spot in that hybrid environment where one bolsters the other and they both feed on each other as far as liquidity is concerned. They're like puzzle pieces that kind of fit into each other in environments where things are exceptionally volatile. Screens just sometimes can't keep up with the size that needs to be executed at a price. Sometimes that's hard in a really volatile environment. And you'll hear people who have long-term experience in many of those volatile environments tell you stories about how I went to go, you know, execute 25,000 call spreads on the screen and I got like 175 done. You know, that's the horror story of the screen trade in a really volatile environment. Whereas you might be able to walk into a pit that has 100 guys in it, 100 people in it, and say, hey, I need a size market on this thing. Where can I get size done? And what happens is, instead of, right, like if I'm a market maker and I have the thing worth $5, and you tell me you need to sell 200 of it, I might buy it for 490 or 495. If you tell me you're going to sell 25,000 of it, I'm just going to say, all right, listen, you're doing a massive amount of size. This incurs a significant amount of like carry risk for me and just like strike risk and all kinds of other risks, liquidity risks. You want 25,000 of them done, you got to sell it at 4.5. Right. And everyone in that pit trading environment might say, yeah, I'll do 5,000 for 4.5. I'll do 5,000. I'll do 5,000. Right. And then all of a sudden you've got, oh, okay, I can actually get 50,000 done at 4.5. Whereas another liquidity environment, like a screen, it's really hard to have that conversation with an algorithm. Right. And so, and I'm not poo-pooing one side or the other. What I'm saying is that there are benefits that exist in a pit trading environment that you just can't get done in a screen trading environment. And then the other side is, right, the screen trading environment does things better than the pit does oftentimes. So I think it's a puzzle piece environment where I think when you find the right connection between the two, it can be exceptionally robust and they can feed liquidity onto each other, which I think is what you're seeing in environments like the SIBO, where, those index options, particularly into the shorter dated stuff that they're seeing now, where a big chunk of the volume is moving into those, weekly or daily options. Those are almost exclusively traded electronically. And the reason why is because they move so fast that a pit broker literally cannot keep up with quoting them in the way that they need to be quoted. That is something that can only happen with an algorithm and a computer. And so, right, that's another side of this. That's one thing that the screen does really well, that algorithms do exceptionally well, that people are just too slow to do. So, there are benefits and costs of each one.
So this kind of moves me into the whole conversation around who is on the other side of the trade, you know, depending on this trade size, right? So who's on the other side if it's, like one call option trading versus 1,000 or 10,000, right? How does that change? Does size change that? And are they the same persons that are warehousing that risk too today?
Yeah, that's a good question. We had a really good question similar to this that came onto our investor education desk recently. And I'll give you the same answer that I gave them, which is when things are trading in a pit environment, right? Let's say you and I are trading in the pit, Renato, and you are a broker and you come in and you say, I have, 500 of these to sell. And I give you a price and you decide to sell them all with me. Say, I'll sell you 500 and then you walk out of the pit. In an old school environment, I would say, what's your house or what's your give up? Or like, I would do one of these, like if we were doing ARB, which means like, what's your house? What that means is what clearing firm are you giving up to me so that I can tell my clearing firm, we need to go meet that clearing firm, right? And tell them, hey, we bought 500 of these for 2.5 and they sold us 500 at 2.5. And let's say you give up, 005, which I think was Goldman back in the day. And it might still be. What that means to me is I write down your acronym 005 and then I paid 2.5 for 500 of them for you. And you do the exact same on your side, except you write down MKC 690. And in that way, in some way who's on the other side, right? You can see the house. You can see the clearing firm where it's coming from. That same kind of nomenclature or same kind of like the way that those are designated does exist electronically as well. Generally speaking, when you trade electronically, if you dig into the electronic record, you can see the house that you're trading with. But the electronic trade has a much more anonymous presence. I don't know, right? We're not sitting face to face. I'm not trading with you. I'm trading on the screen, and it just so happens that it traded 2.5, and I bought 500 of them, but 15 other people bought 500 of them also, right? And so you don't have the same face-to-face interaction, but you still have the same amount of information about it, which is I paid 2.5 for it, and someone from 690 sold it, or someone from 005 sold it. And that's really all you know. As things become more and more electronic, they are going to become more and more anonymous because of the fact that, like, it just doesn't, in many ways, it doesn't matter, and you can't keep track, right? If you're trading 100,000 or 200,000 or 400,000 contracts a day, it's really hard for you to, like, keep a mental note of who you're trading with and, like, what house. However, I will say this, and I put this into the response that I sent to this person also. Generally speaking, the people that are on the opposite side of your trades as a retail investor, if you're selling 5 of these or 10 of them or 15 of them, are going to be the people that are just making markets in, the regular scope of market making. That's going to be most of the, large market making firms that are constantly putting out tight prices and creating liquidity. If you are a much larger player and you're doing something like selling 50,000 call spreads, it creates an event that people take notice of, right? You'll see big prints hit the tape and then be disseminated by people like, prime brokers and brokerage firms. And part of what they're doing is they're saying, hey, this hedge fund sold 50,000 call spreads through Goldman. Much of their job is to say, like, look at this trade. Maybe, and what they're doing is saying to their clients, like, maybe you want to sell it, right? Like, do you want to sell 10,000 call spreads? You've got a bunch of money laying in your account. Maybe we should sell it. They're utilizing the prints to actually create more volume for themselves. They get paid on volume. Don't forget about that. But my point is, when the size increases of those prints, it doesn't necessarily change the players that are involved. It changes the size in which they actually participate, but it's generally the same people that are involved in it. But what it does create is a situation in which people are going to take a little bit more notice of what just happened, right? 5 call spreads that trade in a 0 DTE option that's expiring at the end of the day doesn't really hit the tape. A 50,000 lot of call spreads in DECE, right, that trades in the SPX or trades in the Boone bubble shots or whatever, that's going to create an event where people are going to be like, oh, what happened there? And what price did it trade? And where were futures when it traded? What is the vol level that creates? Like, someone is short a bunch of vol from, this point. And, people start to do all kinds of things with large prints like that because they like to keep track of big players that, have positions that they might unwind. Why? Yeah. I mean, the real end result of this is, why would you keep track of that? The answer is, well, if someone came in and sold 50,000 call spreads, they might at some point need to come in and buy them back. And if you can be the person who, bought the last 500 lot of the 50,000 lot that traded, and then be the person who is the last person on the print on the sell side when they come back to buy it back, you're going to be the person who probably makes the most amount of money for the commensurate amount of risk that you took. And so that's kind of the race that, or the puzzle that everyone's trying to put together in that way. And so you get a little bit of information about who's trading, but you don't know, you're never going to know, the exact person you're trading with, or who the exact other people are that are buying the call spread with you, or whatever is happening, right? It's there are parts, and like I said, as things become more electronic, they will become more anonymous in that way.
Gotcha. And as a, what do you get if you're on the other side, right? Let's say, what do you get in exchange for taking on this risk, right? What does that look like?
That's a really good question. If you're a market maker, I want you to think about it in this way. You have theoretical values for every option on the board, right? Your model is telling you this option's worth $4, or this option's worth $1.50, or whatever. And if you can buy that $4, that theoretical value $4 option for $3.90, you have created what we call edge, right? It's 10 cents. You got 10 cents of edge to buy however many you bought. Generally speaking, you do the math of, like, 10 cents of edge in an SPX product is worth, $1,000. it's this amount of edge relative to theoretical value. Here's the hard part. Most of the time when you pay 390 for something that's worth 4, especially now, you immediately move your theoretical value to 390 because you just paid 390 for it, with the hope that the next person that comes in either sells it at 380 and you get to buy more for a lower price, or in the perfect world pays 4 for it, and then you just like bought it for 390 and sold it for 4. And that's like the ultimate, but that essentially never happens, especially anymore. It used to kind of, I mean, in 1999, that happened all the time. Don't get me wrong. But what you're doing is, right, you're paying 390, moving your theoretical value to 390. And then, right, you're constantly like moving things around to try to essentially capture the bid-ask spread. Because if you're constantly buying on the bid and constantly selling on the offer, and the spread is a dime, theoretically, as long as you kind of manage your risk correctly, you're going to make that dime as many times as you trade. And so that's really, from a market making perspective, what you're doing is you are providing liquidity, aka prices, into the marketplace in exchange for being able to theoretically harvest the bid-ask spread on any number of millions of options that trade. It's not as easy as it sounds because it's an incredibly complex ecosystem now, and the landscape is like, it's so much more complicated than it ever used to be. And people are constantly hedging things in different and innovative ways. Whereas you used to maybe trade just, like, for instance, Xilinx, right? That semiconductor company that I traded in 1999. We wouldn't even really trade like month to month against each other. It was just because people were so simplistically putting on bets. I want to buy the DEES 100 calls, right? Like, okay. And we would sell you the DEES 100 calls. There weren't people that were coming in and saying like, how's the DEES 100, 120, 140 call fly versus the Jan 90, 110, 130 call fly. I mean, that never happened, right? Now, not only does that happen because people are rolling positions and doing all this stuff, but it also happens like electronically. It happens via a broker. Like, there's all kinds of things that are happening now that didn't happen then. The landscape has changed. The actual market making process hasn't changed, but the margins, the actual bid-ask spread that you have to cross as a retail investor. Remember, if you're buying, you're paying the offer. And if you're selling the bid. And if I'm the market maker, theoretically, I'm buying the bid and selling the offer. That's where my edge comes in. But think about this. As a market maker, if the bid-ask spread continues to narrow, which it has over the last 20 years, which is good for the retail investor, that means that the margin compression that is happening on the market making side is getting more and more and more aggressive. And you have to, you have to be more aggressive and more competitive in order to take part in the marketplace. Now, trust me, no one is, writing sad songs for market makers. They're doing just fine. They always have been and they always will be. But it's important to understand that when you see margin compression like that, it's a very real force that has very real knock-on effects in profitability for people that are actually trading the options as market makers.
Gotcha. This is a lot of stuff that you talk about through your role at kind of, doing the OCC stuff. So what exactly do you do at the OCC? How did you end up joining them?
That's a good question as well. So I joined OCC probably almost 3 years ago now. I never really thought I would ever have a career in the education space. But when I look back on it, I was always kind of like positioned in that way without even knowing it. And so this is a very natural outgrowth of my career thus far. My title is I'm the principal of investor education at OCC. What that means is that I work for the Options Industry Council, which is a non-for-profit educational arm inside the OCC. And all we do is provide educational resources about options to the broader public. Now, we do this as a free service because we're fully funded by OCC. OCC is the Options Clearing Corporation. Anytime you're trading an option in the United States in an index or an equity, it's going through the hands of OCC in some sort of cleared, centrally cleared and settled option marketplace. And for that right, OCC charges a variable rate. I think right now it's 2 cents. And that pays for all of the operational expenses that exist in an organization of that size, where we are clearing now north of 12 billion contracts a year. You can obviously do the math there and know that the operational expenses and the operational budget are large, but so is the responsibility and the amount of kind of like risk management that has to occur in order to maintain a level of like a smooth and functioning marketplace that doesn't have a bunch of hiccups in it. Right? We are what we call the foundation for secure markets in the United States. So my job is basically to educate people as to the risks and the benefits of exchange traded options. That's my job. I do that through lots of different methods, one of which is doing things like this. I go out and I do interviews and YouTube videos, and I appear in places and speak publicly about not only who I am and where I've come from, but how I'm leveraging that kind of expertise to actually get the message out, how options work more broadly, right? Like that's my job, is to teach people how options work. A lot of times it helps to be able to lean on the experience that I have as an options market maker to be able to tell people, stories about like how does this work? How, like, what are some of the things that can go wrong in this situation, right? The idea behind what we do is that we teach about the risks and the benefits of exchange traded options. I've experienced both of those many, many times, right? The risks and the benefits. And I can tell you a bazillion stories about how those things work. Sometimes those stories are really effective in getting the point across, to be able to say to someone, listen, this is how puts generally work, but sometimes you have to be on the lookout for a situation in which this happens, right? This should be on your risk radar as a potential outcome for a strategy like this. I can't guarantee how it's going to play out, but let me tell you a story, right? Like, let me tell you one example of how I was in a situation where this happened, and this is how I dealt with it, or this is, one of those situations where I got my teeth kicked in. And I'm not saying this is exactly how it's going to play out, but it's a potential way that it plays out. The other way is that, things might go swimmingly and go exactly as you expected. But eventually what you kind of settle on throughout all of that is, my job is to teach people how they work and to figure out the best way to give people that kind of aha moment where they actually, where the pieces click and they understand how optionality works. At the beginning of this conversation, you and I talked about, again, how you were like reading all of these incredibly complex books. And I would say that's amazing. But I would also say, when you're first learning how options work, sometimes the best way to learn how they work is to trade them in a paper account and get smoked a couple of times on paper, right? Without actually using capital, because you're never going to learn better the lessons that you're going to learn the lessons that I've learned best are the lessons where I've lost the most money. I'm not going to lie. And so everyone has a different aha moment where they're looking at all of this option stuff and saying like, okay, well, calls are supposed to go up when stocks go up and puts are supposed to go down. And I kind of get that, but like, why is this one not going up? Like, and oftentimes people have a hard time understanding, because options are so variable and there's so many strikes and different strategies, and right, it can be a complex landscape. my job is to try to take all of that information, distill it down into like digestible pieces of like transmittable information and say like, this is how these things generally work. Take this knowledge and then build on it. Right. And so that's what we do at the Options Industry Council. We do that from our website, which is optionseducation.org. And we host an entire suite of educational resources there that are very wide ranging and exceptionally robust. It's a fantastic resource and it's free, which is great.
So you actually said one really interesting thing, and I kind of want to add to that is, yeah, I spent all this time reading all these things, but it honestly didn't start clicking until I actually started doing, right? And so actually one thing that I did, sometimes I knock myself for not just doing paper trading first, but what I did was with the capital that I wanted to initially start with, kind of like ideally, I took 10% of that and I basically did everything in the real world. And so
Yeah.
I think having that skin in the game was really like impactful because, when you're seeing things in real time and it's like actually hurting or going for you, you're actually more incentivized to like, okay, what's actually going on here? Should I adjust this position? All this kind of stuff. Yeah. I don't know if that resonates, but yeah.
It absolutely resonates. It's something that I think is really a vital part of the learning curve. And when people ask me whether or not they should start by paper trading, inevitably my response is always, well, it cannot hurt. Like why not try it without risking actual capital first? And if you can find the ability to do that at maybe your brokerage or your clearing firm or whatever, it's a fantastic way to dip your toe in the water and figure out, even if like optionality is for you, maybe it's not for you. I mean, I think it's incredibly variable. And it, from my seat as an options educator, I can hopefully help people understand that there's a part of optionality that is for everyone in some way, shape, or form. But maybe it's not in the way that, your dentist told you they bought call spreads. Maybe that's not for you. And that's cool too. I did have I had a friend who, when he started out, this is a great story. When he started out, he took 80% of his capital and traded it the way that he thought it should be traded. And then 20% of his capital, and he put on the exact same trades in the opposite direction. The exact opposite trades. 20% of his capital and 80% of his capital. And he said the really amazing part was to look at the P&L of those two accounts next to each other, and that the combination of those two numbers was like additively instructive as to why things were happening the way they were happening. Because oftentimes when you have something on and it loses money, it's hard to actually figure out like, well, why did this thing lose money? It like, the stock did exactly what I thought it was going to do. And, why did the option part of this lose money? And sometimes, his thought was, I'll be able to figure it out a lot easier if I have it on the opposite way over here. And I can just go look at it and be like, oh, this part made money and this part lost money. And the combination of both of them helped him. I'm not advocating that as a strategy, but it is interesting to think about it that way, especially when you're starting out and learning how the options actually work.
Yeah. One thing to kind of add is, I've seen you post a lot about it, but you kind of see how much our markets have grown, right? You see also just in the last 5 years, I mean, the volume numbers, the open interest,
Yep.
a lot of that activity is shifting towards kind of like these shorter dated options, right? And in a way, I guess you could think about that being, why would, especially in an environment which things are pretty benign, there's not like, these catastrophic things going on, right? Why would I go out in time and hedge when I could just go on a certain point, right? And just hedge that specific risk somewhere in the distribution, right? Is that the right way to look at that? Is that kind of what's driving a lot of that move from, there is still a ton of longer data activity, but there's the amount that you see shorter dated, right? Is that the right way to look at it?
Yeah. I don't think there's a right or a wrong way to look at it. I think that the numbers speak for themselves, and the SIBO has been exceptionally clear with and like transparent with how much volume they're seeing in those marketplaces, and how they're rotating into shorter dated exposure. I also think that, and I say this to almost everyone when I'm talking about options, especially when they ask, like, are 0DTE options for me? Like, should I trade them, or are they, too risky or what? My response is always, listen, the optionality itself is the most important part to understand. And once you understand the optionality and you have that kind of aha moment, it becomes so much easier to say optionality reacts to time this way, and extrapolate it out in time, and then also extrapolate it in time toward expiration and away from expiration, right? This option should take on the qualities of a Vega rich option as you add duration to it. And this option should take on the qualities of a more gamma rich option as you take time out of it, aka move it closer to expiration. If you understand the actual inherent optionality that exists there, you're going to be so much better prepared to be able to make decisions that are based on a real actual understanding of the inherent optionality, which is really what you need if you're going to be using options like that. The one thing that I will say about 0DTE options and the move to the shorter duration option is that there's a lot of, let's say, financial journalism that is focused on what we would call systemic risk that might be a part of that rotation into shorter duration options. My response to that is always, every option that has ever existed in its lifetime has at one point in its lifetime been a 0DTE option on the day that it expires. This is not a new concept. This is not something that someone cooked up in a lab. This is a changing of the actual cadence of expirations. And if you look at, a lot of the stuff that I put out on LinkedIn, especially about 0DTE options, will be attached to a 0DTE deck that I put together, which gives you a really good kind of history of how we got here. Like, how did we get here within this? And the answer to that is, it's taken 15 years to get to the point where we have an expiration that happens on every day. And the SIBO did it in like chunks, right? And I can explain more about that at some other time, but it's not a new risk. It's a different cadence of risk. And that's an important distinction. But the real core, I think, to that is that the more you understand about the actual basics of optionality, the better prepared you're going to be to not only understand the shorter dated options, but also the longer dated options. Because sometimes shorter dated options can't do for you what you want them to do. You can't get Vega, real Vega, in a shorter dated option, right? An option that has 2 days in it doesn't really have that much Vega in it. It's not going to respond to implied volatility changes as much as an option that has 200 days in it or 100 days in it. And if you're looking for exposure to implied volatility moves, you can't get that in an option that lasts 2 days. So, right, it's a spectrum, and there's a mixture of risk and benefit that go along with duration, just like anything else. But you need to understand the basics of the optionality in order to understand both sides of that.
Yeah, I think the CBOE even came out and they said that a lot of that the positioning is pretty balanced. And at the end of the day, this is just a 1-day exposure, right? It can't be something more systemic, right? It's like at the end of the day, it just rolls off, right?
Yeah. Yeah, I mean, there's that part of it too.
Yeah, yeah. I know you said you only had an hour, so don't want to take too much time. I had so many more questions, but it's okay. We covered a lot. I guess
we can do it again. We can do it again and cover the rest of the questions if you'd like.
Yeah. I guess the thing that I'll end on is, what is the best or worst trade you've had, and what did that teach you?
Oh, geez. Wow. Best or the worst trade that I've had. I will say the worst trade that I have had is, I'm not going to tell you too much of a story about it, but it was an exceptionally high variance trade. that risked essentially 80 to 90% of the capital of the firm, and was put on at an exceptionally illiquid time during the cycle, right? It was something we carried over Christmas, basically, when, like, you know, everyone is wherever they are, right? When you remove players from the actual marketplace, things can do really weird things, right? As far as, like, there's not as many people on cash arb desks to keep things in line, right? Like indexes that have cash components and actual stock components. And if you take all the people out of that trade that normally would trade it and keep it in line, that thing can do really weird things and print in very strange directions. So that's the trade that I think is probably the worst trade. The one thing that I took away from it, for sure, was there's a lot of different elements to risk management. It's not just how many calls I have on this line. There's lots of different things that you need to keep on your radar, and liquidity is one of them, right? Volatility is another one. And then just like cash management is a huge part of it too. How much of my account do I have invested in this one trade, right? Am I too concentrated in risk in something that might be exceptionally volatile? That's a really important part of risk management as well. So those are the things that I learned about it, among other things that are that I can talk about if we have a beer in front of us.
Sounds good. I really appreciate it, Matt. It's an honor. Hopefully we can do this again, maybe even add more things. But thank you so much, and I'll catch you later, okay?
Absolutely. Yeah. Thanks for having me. It was a good time.
Yeah, thank you.
All right. See ya.